Silver just did something it hasn't done in 3 weeks. This morning, February 28th, silver crossed $91 on the COMEX, up more than 9% in 7 days. The January all-time high of 121.64 is sitting up there on the chart like a magnet. And $100, the number every headline writer and every retail investor is staring at right now, is only $9 away. So the question everyone is asking this weekend is simple. Is this the last chance to get in under $100? Or is this the kind of move that looks like opportunity and turns into a trap? OG John AG here. This is financial warfare education, not hopium. That means I'm not going to tell you to buy silver. I'm not going to tell you it's definitely going to $200, and I'm not going to pretend the bear case doesn't exist. What I am going to do is show you exactly what the data says, what the chart says, and what the structure of this market says, and then let you decide. Because there is a real difference between silver going up because of momentum and headlines, and silver going up because the physical math underneath it is broken. One of those is a trade. The other one is a structural shift. And right now, in this market, you need to know which one you are looking at. Let's break it down. Segment 1. What actually happened this week? Let's start with the hard facts because the chart alone doesn't tell the full story. Silver opened this week near $83. By Wednesday, February 26th, it had crossed $90.73, up 4.16% in a single session. That was silver's highest print since February 4th. The intraday high tagged just below $91, a level the market hadn't seen in 3 weeks. Then came the CME halt. Metals trading was frozen. 31,828 silver contracts traded while your screen was dark. When the lights came back on for retail, silver had been slammed roughly $6 lower from the $91 area into the mid-80s. Then it bounced. By Friday, February 28th, silver is back near $88 to $92, depending on what source you're looking at right now. So here's the first thing you need to understand about this week's move. Silver did not go up because of a news headline. Silver did not go up because someone tweeted something bullish. Silver went up because the structural math underneath the COMEX is breaking, and the people who understand that math started moving before the chart made it obvious. The 9% move in 7 days is the chart catching up to a reality that the vault data has been screaming for 30 days. 54.51 million ounces of silver left COMEX inventory in the last 30 days. That is 13% of all COMEX silver inventory gone in 1 month. Registered silver, the metal actually ready and available for delivery, sits at approximately 86 million ounces, and the coverage ratio, registered silver divided by total open interest, is approximately 0.14. That means there is physical backing for roughly 1.4 contracts out of every 10 on the books. You cannot print your way out of that math. And the chart, the $91 print, the 9% weekly move, is the market beginning to acknowledge what the vault data has been saying since January. Segment 2, the $100 level, what it actually means. Let's talk about $100. Because $100 is not just a number. It is a psychological line that changes how this market behaves on both sides of it. Silver crossed $100 for the first time in history in January 2026. It hit $121.64, an all-time high. Then it sold off hard back into the 70s before the current recovery. Today we are at $88 to $92. The $100 level is $9 to $12 away depending on where you are reading this. Here is what $100 means technically. Below $100, silver is in recovery mode. It crossed $100, had an all-time high, came back below. Every technical analyst is watching whether it can reclaim that level on a closing basis. The immediate resistance levels between here and $100 are 91.27. Which silver tagged this week, and then 95.22, which is the next technical target if 91.27 breaks convincingly. Above $100, the psychology flips entirely. Every retail investor who missed the January run and has been waiting for a pullback starts buying. Every headline reads, "Silver reclaims $100." Every fund manager who has been on the sidelines watching gets FOMO. The momentum above $100 historically has been self-reinforcing. So when people ask, is this the last chance to get in under $100? They are really asking two separate questions. Can silver get back to $100? And if it does it stay above $100 or does it fall back again? Here's what the structure says about both. Segment 3, the bull case, why $100 is not the top. If you are asking why silver could not just keep going from $100 to $120 to higher, here is the structural argument. 6 consecutive years of global silver supply deficit, annual demand exceeding mine production plus recycling every single year since 2020. The 2026 deficit is projected at 67 million ounces. Above ground stocks are the only thing bridging that gap, and every surge in price pulls more of those above ground stocks into the market. Old coins, sterling silverware, scrap jewelry, which is exactly what Harry at your local coin shop is seeing in his back room right now. Carts full of silver that came out of people's attics because the price went up. But here is the key insight. That scrap is a one-time harvest. Every ounce of grandma's silverware that gets melted down and refined is an ounce that can never be sold again. The reservoir of forgotten silver is finite. Once it's gone, the only source is mine production, which cannot respond quickly because 75% of silver comes out of the ground as a byproduct of copper and zinc mining. You cannot simply decide to produce more silver. The supply response to today's prices will not show up until 2033 at the earliest. On the demand side, solar panels consume 290 million ounces in 2024. Industrial demand is projected at 650 million ounces in 2026, a number that increases with every new AI data center, every new EV production line, every new 5G tower. There is no lab-grown substitute for silver's conductivity profile. You cannot code your way out of a silver shortage. Gold-silver ratio is at 57, its lowest since 2011. Historically, when this ratio compresses toward 30, it does so because silver outperforms gold violently in the late stages of a precious metals bull market. The ratio compressing from 57 to 30, with gold at $5,200, implies silver at approximately $173. That is not my forecast. That is the mathematical implication of where the ratio has historically gone. And then there is India. SEBI confirmed this week that from April 1st, Indian mutual funds must value their silver holdings using domestic Indian exchange prices, not London LBMA benchmarks. And approximately $385 billion in Indian equity funds just received regulatory permission to allocate up to 35% into gold and silver instruments. That is a potential $134 billion in new institutional demand pointed at metals, with a hard date of 33 days from now. The bull case is not about momentum. The bull case is about 6 years of structural deficit, supply that cannot respond, demand that keeps growing, and institutional capital from the world's second most populous country just receiving formal permission to rotate into the metal. Segment 4. The bear case. Why this could still go wrong now the other side. Because this is financial warfare education, and the bear case deserves to be taken seriously. Silver dropped more than 31% in a single session earlier this year, one of the sharpest single-session declines in decades. The January high of 121.64 was followed by a sell-off back into the 70s. If you bought anywhere near $121 in January, you are still underwater. That is not a small detail. That is what momentum-driven silver moves look like when they reverse. CME still has tools. They can halt trading again. They showed you that this week. They can raise margin requirements, making it harder for smaller traders to hold large positions. They can keep rolling front-month contracts into later months, pushing delivery pressure from March into May, from May into July, buying themselves time without resolving the underlying math. The Shanghai premium, currently approximately $9 above Western spot, could compress if Chinese industrial demand softens. Surveys already show some moderation in Chinese manufacturing activity. If that premium narrows towards zero, one of the key bullish signals disappears. A U.S.-Iran deal, talks are ongoing with the next technical round in Vienna on Monday, March 2nd, would remove the geopolitical risk premium that has been supporting both gold and silver this week. Silver could drop $3 to $5 on a deal announcement alone. And macro risk. If a broad risk-off event hits, a credit crisis, a Fed surprise, a geopolitical shock in the wrong direction, all assets get sold simultaneously. Silver fell below $12 in March 2020 during the COVID panic. Structural arguments do not protect you during forced liquidation events. The most bullish asset on the planet can still be sold when someone needs cash. The bearish case is not stupid. They can keep playing for time. The question is whether they can play for time while 54 million ounces per month keeps leaving the vault. And the answer to that question is what March 2026 is going to start revealing. Segment 5. The coin shop signal. Here is the ground-level picture that confirms something real is happening, not just on a chart, but in the physical world. Local coin shops right now are reporting two simultaneous realities that sound contradictory, but are actually perfectly logical. Back rooms are overflowing with silver, sterling silverware, old jewelry, bulk junk silver, world coins, all of it coming in because prices went up and people are selling. Refiners are refusing or delaying pricing on certain categories, telling dealers, send us the metal and we'll email you when we're ready to lock a price. Which in plain English means we are overwhelmed with inflows and we don't want your low priority scrap right now. At the same time, American Silver Eagles, Mercury Dimes, pre-1964 90% coins, flying out of the cases the moment they are priced. What does that tell you? Not all silver is the same silver. A pile of sterling spoons in a coin shop back room is not the same as a 1,000-ounce COMEX deliverable bar of 99.9% pure silver. The metal exists. It is in the wrong form, wrong purity, wrong place for the buyers who need it most. The refiners being overwhelmed with scrap while specific bullion products sell instantly. That is what the early stages of a structural squeeze looks like at the retail level. Metal exists. Converting it takes time, capacity, and higher prices. And the $100 level, and whether we are below it or above it, is part of the price signal that tells the system how urgently to convert. Segment 6. What $100 silver actually requires. Let's be very specific about what has to happen for silver to cross $100 and stay there. Technical requirement, silver needs to close convincingly above $91.27 on the COMEX. That is the immediate resistance level tagged this week. A convincing close, not a spike and reversal, but a daily or weekly close above that level, opens the path to $95.22. Above $95.22, the next technical cluster is $100 to $102. Structural requirement, COMEX registered silver needs to either stabilize above 80 million ounces, showing the drain is slowing, or continue falling, which would accelerate the delivery stress narrative and push more institutional buyers to act before the math gets worse. Catalyst requirement, one of three things historically pushes silver through round number resistance levels: a geopolitical shock that increases safe haven demand, an institutional announcement, a sovereign wealth fund, a major ETF, a country, declaring significant new silver purchases, or a COMEX delivery failure or emergency measure that makes the paper-physical gap undeniable to mainstream participants. Vienna talks Monday, India's April 1st regulatory shift. First Majestic Silver's Q1 earnings call. Any of those could be the catalyst. None of them are guaranteed. What is guaranteed is this: the math underneath $100 silver has never been more structurally supportive than it is right now. 6 years of deficit, 86 million ounces in registered inventory, 0.14 coverage ratio, India's capital formally permitted to move, Shanghai paying $9 premium that survived a $6 paper slam. The math says $100 is not a question of if. The math cannot tell you when. And when is the part that costs people money if they are wrong on timing? Segment 7. What to actually watch. I sell nothing. No courses, no signal groups, no Discord, no affiliate links. If you see my name on a paid service, it is a scam. You find me here on YouTube and on X. Here is your watch list for the $100 question specifically. All public, all free. $91.27 on a daily close. This is your immediate signal. Silver has tested this level twice this week. A clean daily close above it, not an intraday spike, is the first confirmation that the path to $95 and then $100 is open. A rejection here and a close back below $88 is the first warning sign. COMEX registered silver daily updates. CME Group website, free. If registered silver drops below 80 million ounces during March delivery, the drain is accelerating, not stabilizing. That is structurally bullish for price, but also means delivery stress is worsening. Vienna talks Monday, March 2nd. U.S.-Iran technical talks resume. A deal announcement, even a partial framework, could knock $3 to $5 off silver in a single session. A breakdown of talks could add $5 to $8. Know this is coming before the market opens Monday. India, April 1st, 33 days away. Watch for any Indian fund manager announcements about new silver allocations in March. The first institution to publicly announce a new silver position under the new CB framework will move the price. Shanghai premium versus COMEX. If the $9 premium narrows toward $5, physical demand in Asia is softening. If it widens toward $15, the physical market is increasingly separate from the COMEX paper price, and the paper price eventually has to come up to meet reality. Outro. The honest answer to the last chance question. So is this the last chance to get in under $100? Honest answer? Nobody knows. Not me, not the analysts targeting $180, not the banks targeting $65. What I can tell you is this: the structural case for silver above $100 is more solid right now than it has ever been. 6 years of deficit, vault drain at 13% per month, coverage ratio at 0.14. India opening the door to $134 billion in new metal demand. Shanghai maintaining a $9 premium through a $6 paper slam. At the same time, silver already crossed $100 once this year, hit $121, and came back to $70. Anyone who bought at $121 thinking it would never come back is a reminder that the structural story and the short-term price action do not always move together. The coin shop reality, carts full of scrap in the back room, eagles flying off the shelves in the front, tells you what kind of market this is. The physical world and the paper world are running on different tracks. Every cart of sterling silverware Harry processes is part of the finite reservoir being drawn down to mask a structural deficit. When the easy scrap is gone, the deficit has to be closed by price. That repricing does not announce itself in advance. It does not put last chance under 100 on a sign. It happens when the structure finally cracks, and the people positioned before the crack benefit, while the people waiting for certainty buy at $150 wondering why they hesitated at $92. This is financial warfare education, not advice. Your edge is not guessing when $100 happens. Your edge is understanding whether you believe the math is broken and positioning accordingly, with risk you can actually manage before the screen confirms what the vaults have been saying for 30 days. If you watch this far with your brain turned on, drop OG John AG in the comments and tell me, does the $100 level feel like resistance or a doorway to you right now? OG out.